In this video, we will see how to prepare closing entries and a post-closing trial balance. Closing entries are the journal entries that are made at the end of an accounting period. It is used to transfer data in the temporary accounts to the permanent accounts. Temporary accounts are those accounts that relate only to a given accounting period. Income statement accounts, like all revenue and expense accounts and owner's drawings accounts, are temporary accounts. They are closed and not carried forward to the next accounting year. On the other hand, permanent accounts consist of all balance sheet accounts like asset accounts, liability accounts, and owner's capital account. These accounts are not closed from period to period and carried forward to subsequent years. Note that all temporary accounts have zero balances after posting the closing entries. Permanent accounts are not closed, and their balances are transferred to a post-closing trial balance. A post-closing trial balance is a list of ledger balances after posting closing entries. Since the closing entries transfer the balances of temporary accounts to the permanent account, the new balances of temporary accounts are zero and therefore are not listed in a post-closing trial balance. Only the balances in the permanent accounts are recorded in the post-closing trial balance. It provides the opening balance of the permanent accounts for the new accounting period. Let's look at an illustration to see how we prepare closing entries and a post-closing trial balance. The adjusted trial balance of Dexo Company is provided for the month ended June 30th, year 1. We are required to prepare the necessary closing entries at June 30th, year 1 and a post-closing trial balance. First, we close all revenue accounts. The only revenue account is service revenue. The entry to close the revenue account is a debit to service revenue for $5,250 and a credit to income summary for the same amount. This transfers the balance in service revenue to the income statement. Next, we transfer the expenses to the income statement. To record this, we credit salaries and wages expense for $1,920, miscellaneous expenses for $228, and supplies expense for $1,708. We must also debit income summary for the total expenses of $3,856. Note that the income summary has a credit balance of $5,250 and a debit balance of $3,856. The excess of credit or revenues over debit or expenses is the net income for the period. This is transferred to the owner's capital by debiting income summary for the difference of $1,394 and crediting owner's capital for the same amount. Finally, we close owner's drawings directly to owner's capital and not to income summary, as owner's drawings is not an expense. To record this transaction, owner's capital is debited for $920 and owner's drawings is credited for the same amount. After preparing the closing entries, we now prepare the post-closing trial balance. The post-closing trial balance contains only permanent accounts. Thus, we have cash of $4,000, accounts receivable of $4,716, supplies of $658, accounts payable of $2,056, salaries and wages payable of $640, unearned service revenue of $220, and owner's capital of $6,458, which is determined after adding net income to it and deducting the owner's drawings from it. Total debits equal total credits, each total being $9,374.